supply shocks are becoming more frequent. Model-based analysis by ECB staff shows that during the recent inflation surge, such shocks played a much greater role in driving inflation than they had over the previous 2 decades. And even today, supply-side forces continue to generate inflation risks in both directions. Second, we see mounting evidence that more regular supply disruptions are leading firms to adjust prices more frequently, contributing to greater inflation volatility. And this is not simply an extrapolation from the most recent shock. Rather, it reflects a structural shift in how firms operate under conditions of permanent higher uncertainty. Our research shows that in such an environment, firms tend to react more quickly to shocks, especially supply ones, in order to protect against potential future losses. At the same time, they're more likely to adopt more flexible pricing strategies, which means prices may respond not just to major shocks, but also to smaller frictions and local disruptions. Third, if inflation becomes more volatile, we could see non-linearities on both sides. In our last strategy review back in 2021, we rightly focused on the nonlinear dynamics that emerge in a prolonged environment of too low inflation, where interest rates are eventually pushed to their effective lower bound. That constraint can in turn feed into inflation expectations and risk creating a self-fulfilling low inflation trap. And of course, we remain alert to the possibility of renewed downside inflation shocks. But recent experience has also revealed non-linearities on the upside. Since firms are generally quicker to raise prices than to lower them, more frequent price adjustments mean inflation can rise quickly in response to large upside shocks. And if wages then adjust only gradually to these price increases, as we saw in recent years, inflation may remain above target for longer as wage growth slowly catches up. And this in turn can raise the risk of inflation expectations de-anchoring to the upside. So the next question that follows from this assessment is, if the economic environment becomes more volatile, how can we make our economic assessment more robust? Large shocks can trigger feedback loops and nonlinear effects that inherently give rise to a broader range of possible outcomes. In a world of higher uncertainty, it is all the more important to augment the baseline with alternative risk scenarios, to augment the baseline. Not to compete with the baseline, to augment it. And this is why the second conclusion of our assessment is the need for monetary policy to take into account risks and uncertainty using a systematic but context-specific approach. Systematic but context-specific. The ECB has used both scenario and sensitivity analysis for many years, deploying internal scenarios since the global financial crisis and publishing them for the first time during the pandemic. But our experience in the recent years has underscored the particular strength of scenario analysis in times of elevated uncertainty. Let me give you an example. Russia's unjustifiable invasion of Ukraine and the resulting energy price shock. In that case, scenarios provided insights that neither our baseline projections nor standard sensitivity analysis around the baseline could fully capture. For instance, in March 22, the invasion of Ukraine was February 22. In March 22, just a few weeks after, our baseline projected inflation at around 5% for that year, based on market-implied energy future. The sensitivity analysis suggested a slightly higher figure of about 5.5%. In contrast, the Ukraine war scenario already pointed to inflation exceeding 7%, close to the final annual figure of over 8%. At the same time, there were moments when, in hindsight, publishing scenarios could have supported both our policymaking and our communication. One example was the high uncertainty in 2021 about the speed of vaccine rollout and the nature of post-pandemic reopening, including the sectoral shift in supply and demand across goods and services sectors, both in the euro area and globally. Scenario analysis could have helped in illustrating that the range of possible inflation outcomes was unusually wide and would have reduced the risk of projecting false certainty to the public. And this is why our updated strategy